This is Simply Tech. And I'm Lily.
Thanks, Lily. It's Friday, April 3rd, and with all the latest and fast-moving developments in the tax world lately, it's clearly tax season not normal this year. Case in point, a coffee break conversation I had with my new 5-year-old twin coworkers while working from home these past few weeks led to my daughter Lily wanting to record on the podcast like Daddy. And I think it's safe to say this episode will have the best intro and sign-off in Simply Tax history. But of course, I may be a bit biased. To help you unpack what seems like hourly updates in the tax world right now, I called up a few friends of the podcast to continue our COVID-19 response series with a closer look at what's happening and provide answers to common and listener questions right now. I'm excited and honored as always to kick things off today with Ed Karl, the Vice President of Taxation at the AICPA, to provide an inside look at the deadline relief provided that generally makes July 15th the new April 15th, of course with a few exceptions. Then, Julia Dengel and Yelena Bosovik of BKD's National Office Tax Team will break down what's in the CARES Act for individuals and businesses and take on and provide answers to many of the questions swirling out there right now. Being that it's tax season not normal, the audio quality of our calls perhaps isn't quite what you typically hear on the podcast, but I think you'll agree the insights shared are top quality. Speaking of top quality insights, let's jump in with Ed. I don't even know where to begin. I'm trying to think the last conversation we had, which is well before all this, kind of at the beginning of the year even, you just couldn't even kind of contemplate the situation we're in now. So
no, not even, I'll bring it up even to March 1st. So the last time we spoke, it had already started. This COVID-19 is 19 because it started in 2019. It really didn't escalate here until the end of February, I would say, or in February with all those cruise liners and coming into the West Coast, and it started to escalate in Washington State. But around the 1st of March, I put together an internal team to start considering what we might have to do in reaction to this. And even March 1st seems a lifetime away, Damien, because we had no idea that it would escalate to this point so quickly. I was sort of sensing, based on what we saw around the world and how it was spiking after a certain amount of time in different countries, that by April 15th, we could possibly have a big problem here. And then I started to get a few calls coming in to me and a few emails from members from Washington State and New York expressing some concerns, and that really escalated in my mind. When I hear from one member, I listen to them and I sort of file it away. But when I start hearing from even 2 or 3 or 4 members, that's all it takes in a short amount of time, then my radar goes up big time. And it did. And I started getting concerned. So we started reaching out to IRS and Treasury to talk to them about our concerns. And as time started moving on, the first week of March or so, and we started moving towards March 16th, the deadline for partnerships and S-corps. And the calls from members started escalating. We really ratcheted up our contacts with IRS and Treasury, but they didn't have the same level of concern about March 16th. I think Treasury was pretty focused on the economic impact. That's about the time when the market started cratering and people stopped working, and cities and then states started social distancing, and it just started to escalate so quickly, Damien. So I think that the government then started realizing that the April 15th deadline was in jeopardy. I think they weren't quite as concerned with the business returns. March 16th, they were indicating that partnership returns are often extended anyway, and So we started talking about reasonable cause abatement for those returns. I think that's where government was headed for business returns, having to deal with reasonable cause abatement. But once we got just past March 16th, that is where we crossed the line.
Again, it seems like an eternity ago, but I do remember very vividly kind of going through that. And I know you and your team were very involved and continue to be very involved in advocating for taxpayers and practitioners with what this means and adjusting things, the deadline and so forth for the result of all this. So, yeah, maybe you could talk a little bit about what that was like and how that's been progressing, and even maybe what we maybe would still like to see if the service would offer more guidance and more relief with respect to deadlines.
March 11th, Secretary Mnuchin alluded to some kind of tax season relief in a press briefing with the president. And then a couple days later, on Friday the 13th, an auspicious day, the president issued an emergency declaration under the Robert T. Stafford Act. The Stafford Act is the mechanism that allows government to circumvent rules that they normally couldn't. So whereas due dates for tax returns are set in the Internal Revenue Code and the IRS can't change that, the Stafford Act in emergency or disaster situations allows them the authority. They just did this about a month ago for the tornadoes in Nashville, where they broadly provided relief based on the destruction from those tornadoes. And they do it every year throughout the year for various types of disasters. When the president issued that emergency declaration, we thought we were going to get the filing relief. And we worked over that weekend and were in contact with Treasury quite a few times over the weekend about our concerns on March 16th. But ultimately, they did not release a notice until Wednesday. So the due date for the 1065s and the 1120s was Monday. It wasn't until 2 days later that they issued the notice 2020-17, which only provided payment relief. And we had started hearing from our members even before then, where Secretary Mnuchin was talking about the emergency declaration, and we tried to calm people down, saying that he was talking about payment relief, but we had never seen in an emergency situation where they didn't provide both. In retrospect, and understanding the conversations we were having, there was a great deal of concern that Treasury had with the economy, and rightfully so. They were concerned that if they provided filing relief, the many millions of outstanding refund returns that could be filed would not be filed. And they wanted those refund returns, they wanted the checks to get back to taxpayers, the money deposited and spent. And that was a big concern that they had. Nevertheless, we were explaining with the escalation every single day that taxpayers and their advisors didn't have a choice. They were not able to file. How do you even file refund returns if you want to e-file, but you can't get the manual signatures? So we kept the press on around the 16th, 17th, 18th of March when that notice 2020-17 came out. We kept the press on. But we also reached out to the Hill, and John Thune, Senator John Thune of South Dakota, understood the concerns we had with not obtaining filing relief. And he introduced a bill, S-3535, the morning of March 19th. And by the end of the day, there was a bipartisan list of 32 co-sponsors in the Senate to that bill. It was maybe the watershed for this effort, because the next day the IRS issued Notice 2020-18, which also provided the filing relief. Now, that filing relief was very specific to April 15th. There were concerns that we had immediately when we read that notice, and that we were hearing immediately from our members, to the point that by the end of that weekend, we had compiled a list of about 120 issues surrounding the limitations of that notice. For example, we heard from many CPAs who had exempt organization clients whose returns for calendar year 2019 were due May 15th. What about those returns? What about if those entities had to pay you unrelated business income tax? We heard from CPAs who had calendar year employee benefit plan reports that had to be filed, the Form 5500 series, who had fiscal year August and September entities whose returns were due March 31st and April 30th. What about those entities? We had questions about IRA payments. There were questions about minimum distributions from IRAs. There were all sorts of questions. What do taxpayers out of the country do? What do non-residents do? What if you wanted to take advantage of the Form 4868 extension to October 15th? When do you file that, and can you file that? What about the estimated payment that was due June 15th, a first quarter estimate that was due April 15th, but not the June payment? So all those issues were out there. Several days after they released that notice, on March 24th, they released a Q&A document. And that Q&A document did two basic things. It did provide answers to a couple of items, like what do you do about IRA payments, which they answered you have until July 15th to make that payment. What about the Section 965 international transition tax that's due with the corporate return April 15th? They extended that because it was due April 15th. But so many other issues were unanswered because they basically stayed in the Q&A document. They stayed within the four walls of the notice, and they didn't answer them. That was a big problem, and we've heard from so many people, and even from the time that they submitted the first notice, 2020-17, until today, the world has changed. Unfortunately, the escalation has continued. The spiking of cases, coronavirus cases, has continued and continues to impact the ability of taxpayers and their advisors to file and pay. So it's a really tough situation.
The world has just changed. The mindset has changed. And even just kind of like you said, the awareness of kind of what's at stake with getting the refunds out and not wanting to be premature in that and thinking how this can really impact everybody. I mean, I think there was obviously a lot of back and forth on it and maybe some confusion that stemmed from it. I guess any advice to taxpayers and practitioners now that we kind of have the FAQs, maybe we still, like you said, have some more pieces to it that because so much rides on the deadline that we'd like to understand, but how do you digest it? How do you make sure that you're doing what you need to do in light of this?
You know, one of the things that we agreed on when Treasury was concerned that the refund returns wouldn't be filed because of the hit that the economy is taking, we agreed with that concerns, and AICPA is looking into various options of ways the organization can play a role with helping business and helping the economy. One of the things that we've been doing in all of our messaging is encouraging CPAs to file returns, particularly refund returns, where it's possible and safe to do so. And those are two tricky issues there. If it's possible and safe, and as time moves on, at least through April 15th, I think various parts of the country will start to spike and hopefully will start to improve after that. But the improvement is going to come after April 15th. So we are encouraging where it's possible and safe to do so. I think, Damien, part of the answer to your question is that reasonable cause relief is always available on a case-by-case basis. are almost always available. And I think, unfortunately, if taxpayers are ill and or their CPAs are unable to file because they have staffing shortages, technology problems because of accommodations they have to make, it's just not possible or safe to file. They're not going to. They won't be able to. And they'll have to avail themselves of reasonable cause abatement at some point down the road. But we're hoping that there's still time for IRS and Treasury to issue additional relief. We submitted another letter, and we're calling on Treasury to adopt a policy for any return and any payment due between March 3rd of this year and July 15th, that they provide relief. It means for any form, any taxpayer, any type of tax, not just income tax, that broad relief is appropriate at this point. And it could be, I mean, we'll monitor the situation, and I'm hoping that by July 15th across the country, there will be past the spike and on a downward curve in the graph, and the country is healing and starting to improve. I'm hoping that. But it's possible not, and they might need additional relief even beyond July 15th. But as of today, we're calling for relief between March 3rd and July 15th.
So I'd be curious from the conversations you've been having too. Like you said, it is probably depends on geographically where you are, kind of your community, the response. So much involved, and right, even if you as the taxpayer or you as the practitioner are directly impacted. But I guess how are you hearing? I guess practitioners approach that. Is it a mixed bag, or kind of other common themes that you're seeing in terms of the response at this point in time?
I've been at AICPA for 37 years. And the one constant that I've had in all those years is that there is some kind of a natural disaster. Every year throughout the year, we get tornadoes and hurricanes and floods and mudslides and fires, and there are snowstorms, and they hit different parts of the country at different times. And there are presidentially declared disaster areas designated, and IRS provides broad relief to those taxpayers. And what I've heard, the question you were asking me, heard from CPAs through all these years is they don't like a hurricane will be hitting in Florida, as an example, and the governor evacuates the east coast of Florida. And CPAs call and telling me they're not leaving because there's no extension, and the hurricane is hitting October 13th. And they said, it's the end of the filing period. I have to file returns. I can't leave. And I said, you've got to keep you and your family and your staff safe, and know that at some point soon the IRS will provide relief. And the problem is it may not come for a week. So I get similar types of reactions from CPAs. They're desperately concerned about fulfilling their duties to their clients and to their profession and doing the right thing. But we're in really unusual times right now, and you could hear the desperation in their voices that they're concerned about not being able to do it, not being able to be the professional that they're used to being, and not being able to meet deadlines that they've met their entire professional careers. And you can hear the desperation in the phone line. And that's what we've been passing on to Treasury, that it's escalating, and they've got to provide the relief.
Again, it's sort of uncharted and very unprecedented, I guess, right? Because we're in an election year. You typically don't see tax legislation in an election year, but clearly all bets are off once this came along. So maybe you could speak a little bit to that and kind of some of those provisions and what taxpayers and practitioners should be watching for and looking for as some of this comes into place and the relief becomes available.
There were 3 phases of coronavirus-related packages. The first one, the beginning of March, was a supplemental appropriation. So Congress provided a little more than $8 billion in emergency funding to federal agencies and a small amount of loans to small businesses, some money for the purposes of working on vaccines and additional medical supplies, that type of thing. Then we had, I don't think there were any tax provisions in there, but we did have on March 18th, the second phase, which was the Family First Act, the Families First Coronavirus Response Act. And that did have some tax provisions, including an expansion of the emergency paid leave provisions and additional paid sick leave and credits to businesses. And then the Coronavirus Aid, Relief, and Economic Security Act. And that does have some tax provisions and changes, for example, to the loss carrybacks that were eliminated with TCJA and a host of tax provisions. My team has been organized around going through those two bills and looking at the outstanding issues in there. There's going to be a need for guidance from IRS. Guidance is already coming out for the Families First Act from the Department of Labor. Some of that not so good news for some people. We're already hearing from CPAs about that. The law pretty much limits the effective date of that to after the date of enactment, and the date of enactment was March 18th. So we have questions from the DOL guidance. DOL says that it applies to leave taken between April 1st and December 31st of this year. We're already getting questions. What about people who were ill in February and the beginning of March or in all of March? People who missed work and didn't have leave. So what are you going to do about all those people? But that seems to be how the statute was written. We're looking into that and looking at the DOL guidance as well. So there's a lot to do, and trying to get all of our advocacy teams in DC aligned to look at what the open issues were. We've been so busy with all of the filing issues, and now we have these issues to look into as well.
A lot of tax things, I guess we'll say, to make it very generic and overgeneralized to digest right now. And with many of them, impacting prior returns, 2018, 2019 returns. Actually, in fact, many of the provisions we've even talked about as we were talking about the TCJA and all of that, that seems like an opportunity for tax practitioners to really be able to help taxpayers at this time with those relief provisions.
Right. So then the question is how quickly you do it. And rolling back up more than just the NOL carrybacks, I think there were interest provisions and interest limitation provisions. And I think is something that we've talked about many times, Damien, the extenders. I think they got what we've discussed, and they call the retail glitches in there, which fixed the technical issue with providing rapid write-off to certain small businesses. And then the question is, when will all this get done by CPAs? When can they do it? When will we return to some semblance of normalcy in the world where the work can be done as well? So that remains to be an issue. But, and as you said, we've talked about this a number of times. Legislation in an election year, tax legislation in a presidential year doesn't happen. But this is an unprecedented period that we're living through, and it requires an unprecedented response by Congress and the administration, and by the entire business community and by the CPA community.
So I guess, kind of with where we are now, again, I know there's a number of things. You mentioned the letter. What's kind of the focus as we even get beyond this third relief or stimulus bill? What should we be focusing on, and what kind of provisions do you think to be watching for?
Well, we have to take a look at the CARE Act, but there are mechanisms to get money to individuals, small businesses, relief directed to certain industries as well. So we have to see how those mechanisms work and the role that CPAs play in those relief mechanisms. As I mentioned, my team is getting together to sort of catch our breath and see what else has to be done, what other issues are out there, where the gaps are. There's so much happening so quickly, and it's so I was sort of say it's funny. It's not funny, but you and I have spoken, as I mentioned a moment ago, about extenders, about technical corrections so many times, and when you have legislation that moves so quickly, that things happen, and there may need to be additional fixes. We talked about three phases, three pieces of legislation, the supplemental appropriations, and then the two bills, the relief bills. There's likely to be more. There's likely, as time goes on, to be the world will be a little bit clearer. The new world, as we see it, will be a little bit clearer, and Congress will probably have to provide additional relief. And it's possible, as we identify problems with the legislation, technical corrections, if you, as it were, that might be needed. We'll have to pass those on to Congress, and they might be able to fix those relatively quickly.
The speed here is the part that I think has just really struck me. And right, and with so many moving pieces that are so complex that usually take, again, putting it very generally and basically a lot longer, have been just really, because of the need, sped up and kind of pushed through. So yeah, I would expect, as there always is, the need for the guidance, the need for perhaps fixes, and the like. So that completely shifts the mindset and the approach and the strategy, even for what you and your team are working on for the foreseeable future. I would have to think.
Periodically, I have a call internally with several of the staff, some of the leaders in the organization, to give them a high level overview of what's going on in the tax world, because our staff meet with our members in various venues. They speak at conferences or visits, council meetings and board meetings, and so we give updates on what's going on. And the question was, are we talking about anything else other than coronavirus related issues? And the answer is right now, no. I mean, my staff hasn't stopped on other issues either. We've spoken about digital tax, virtual currency, and guidance related to TCJA, all sorts of things. Ironically, disaster legislative fixes that we've been working on. And all that work does continue to go on, surprisingly. I don't know how we have the capacity for it all, but we are doing that in addition to all of the coronavirus related work that has to be done in the short term. So by and large, a lot of other things are slowing down a little bit, and we're focusing in this area.
Any closing thoughts or words of wisdom from your experience? Again, I appreciate what you say about the, interacting with the practitioners, that you have a career of that. And so you kind of have that perspective of knowing how this differs from other situations. So yeah, I guess what would you say and what would you leave people with on it?
Well, I guess number one, the message is we want CPAs and their families and staff to be healthy and safe. That was what I was trying to explain before. It's hard for them to see that when they're facing a professional challenge, but they've got to keep that front and center in their minds. That's number one. Number two is have a little bit of patience and catch your breath about filing season. As I mentioned before, number one, there's always reasonable cause abatement relief for one-off situations. And then we're continue to work on behalf of the profession and on behalf of the tax administration in general to try to get additional relief, which we think is appropriate. And we'll see as time goes on. We hope that Treasury will be able to meet us and see eye to eye with us on that and provide additional relief. So that, again, the second thing is I'm hopeful that there'll be additional relief out there that will take some of the additional pressures that are out there and take some of that pressure off CPAs. And the last thing that I'll say is we still need to hear from everybody. We do hear already from our committee structure and hear from a lot of members, but I would encourage you and your firm and others who listen to your podcast, that we need to hear where you see issues or anticipate problems. Always sending that information to us helps us be more effective.
So that's the scoop on the federal deadline relief. We've included a link in the show notes to the March 26th letter that Ed mentioned, where the AICPA noted several outstanding deadline-related issues, which although did lead to Notice 2020-20, which postpones the federal due date for filing Form 709 and making federal gift and generation skipping transfer tax payments from April 15 to July 15, 2020, there are many more of these issues outstanding as of right now. The AICPA continues to urge both the Treasury Department and the IRS to address and provide broader tax filing and payment relief, as well as to take more aggressive steps to protect taxpayers and tax preparers in regard to COVID-19. And you can learn more about these efforts and share what you are seeing and hearing with the AICPA with the additional links to the AICPA resources in the show notes. Now, as Ed discussed, we've seen two pieces of enacted relief-related legislation with significant tax changes so far this year. Here's Yelena to talk about what's in the most recently enacted CARES Act for individuals.
So the CARES Act provides, I think the big one is that everyone's talking about the news. That's basically all they mention is the recovery rebate checks, which is $1,200 per individual and $2,400 for married couples filing jointly, plus $500 for each qualifying dependent child, which in the most current version of the bill that passed the Senate defines a child as a minor child under the age of 17. So these are checks are expected to go out electronically if the IRS has your electronic banking information. Otherwise, they'll be sending out paper checks. And I think the expected timeline is up to 3 weeks as of now. The recovery rebate a taxpayer receives is based on information reported on a taxpayer 2019 tax return. If you did not yet file your 2019 return, the IRS will use your 2018 income. And if you didn't file a tax return in either year, they're going to use an individual's 2019 Social Security income. And it's important to note that this is a credit against your 2020 federal income taxes. So you'll have to take this into consideration when you do your taxes at the end of this year. And not everyone's going to get a check. You'll need to have provided a valid Social Security number for yourself, your spouse, and any qualifying children on your tax returns. Additionally, this credit begins to phase out for taxpayers whose adjusted gross income exceeds $150,000 for joint returns, $112,500 for head of household, and $75,000 for other taxpayers. Once you're over those thresholds, you'll lose about $5 of your payment for every $100 of your adjusted gross income that exceeds those thresholds. So that's the big one that everyone's been asking about, but there are a couple other provisions for individuals to kind of provide some flexibility to get cash flow. There's two provisions for getting money out of retirement funds. So the CARES Act waives the 10% penalty for early distributions from qualified retirement plans for up to 100,000 of coronavirus-related distributions in 2020. Taxpayers may repay these amounts within 3 years of withdrawal, and they're subject to taxation, but you can spread that out over 3 years if you would like to do that. This relief is available for an individual who's been diagnosed with COVID-19, whose spouse or dependent is diagnosed with COVID-19, who experiences adverse financial consequences as a result of being quarantined, furloughed, laid off, or having work hours reduced, being unable to work due to lack of childcare due to COVID-19, closing or reducing hours of a business owned or operated by the individual due to COVID-19, or other factors as determined by the Treasury Secretary. The CARES Act also provides a temporary waiver of the required minimum distribution rules for certain retirement plans and accounts. And taxpayers who do not otherwise elect to itemize deductions are allowed an above the line deduction in 2020 for up to $300 of charitable contributions made in cash and not in stock to any qualifying 501c3 public charity, and this excludes donor advised funds. For those taxpayers who do itemize, the CARES Act temporarily increases limitations on deductions for charitable contributions made in 2020, and they do so by suspending the 60% adjusted gross income limitation for individuals who make cash contributions to qualifying organizations. And for contributions of food inventory, the limitations increase from 15% to 25%. And all of this is subject to existing charitable contribution carry forward rules. And then finally, the last minute addition to the final bill is a provision allowing employers to provide student loan repayment or tuition assistance to employees, and that is capped at $5,250 annually per employee. And this provision is effective until January 1st, 2021. So this is the last minute provision that was added, and we're looking into the details, but that is a option for employers who want to help employees during this time with any type of tuition assistance or student loan repayment.
So that's individuals. How about businesses? Here's Julia to boil down the tax changes under the CARES Act.
There's definitely a lot, but similar to the provision for individual taxpayers, the CARES Act also temporarily increases that 10% limitation imposed on corporations for charitable contribution deductions. It increases that to 25%. The CARES Act also included a highly anticipated technical correction to the 2017 Tax Cuts and Jobs Act, which was the fix that will allow companies to apply the accelerated bonus depreciation rules to their qualified improvement property. And it's actually the way that the provision is written, it's going to be retroactively applied as if it was included with the original TCJA. So another thumbs up there. And also, so under the CARES Act, the current net operating loss rules that were put in place by the TCJA, they're going to be temporarily revised to allow losses arising in tax years 2018 through 2020 to be carried back for 5 years. And also, the 80% limitation is suspended for taxable years beginning before January 1st, 2020. 2021.
It's a mouthful. There's so many dates, so many years. It's like it's almost
so many
like
twos.
So many twos. It's hard to say. So I feel like there's going to be a lot of tax year confusion coming out of all this. Would you agree?
Absolutely. Something that Yelena and I were talking about is there's so many dates in this and in the Families First Act, effective dates, some dates that haven't even been established yet that are going to be coming through regulations or guidance from the IRS or Department of Labor. So it's definitely a lot of dates to kind of keep track of, keep your head wrapped around, and not to mention just the various drafts that came through. And so we were trying to keep track of, well, this version 1 said this, version 2 said this. Okay, what has changed? What is actually in the law? So it's definitely a lot to keep track of. Another key provision in the CARES Act affecting businesses is that it temporarily modifies the 30% limitation on business interest expense deductions that was originally provided within the TCJA, and it increases that limitation to 50% for tax years beginning in 2019 or 2020. And so what this is going to do is allow those businesses that are kind of strapped for cash and trying to increase their liquidity with a reduced cost of capital for them. So the rules there for partnerships are a little bit more complicated. It's not as straightforward as just increasing that adjusted taxable income limitation to 50%. But I will say that the rules do provide a little bit more flexibility for partners that are allocated any excess business interest expense from a partnership during 2019. So it's a little bit more complicated, but just rest assured that it does provide relief for those partners in partnerships as well. Another late addition to the CARES Act that was actually included in the law as passed was a provision to temporarily waive the federal excise tax on any distilled spirits that are used or contained in hand sanitizer. So any distilled spirits that are used to produce hand sanitizer or distribute that hand sanitizer in accordance with FDA guidance during 2020, that federal excise tax is going to be waived. So I think that's a pretty nice addition to the law and something a little bit quirky and outside of the normal realm of some of these changes that we're seeing.
So as you might imagine, all this fast-moving tax stuff has created a lot of pressing questions for taxpayers and for those that advise them. You've got questions and we've got answers. Well, at least to the ones that we know at this point, since things continue to develop and guidance still continues to come out. Let's kick it back over to Yelena to cover some common questions under the Families First Coronavirus Response Act.
Yeah, so I'm going to speak more to the Families First, so the second legislative package that went out, just because that has been out in the world a little bit longer. So we've had more questions on those. And I think a lot of the questions are around, is my company subject to this? And the threshold, again, is that 500 employee threshold. Unfortunately, those rules are set up under the Family Medical Leave Act and the Fair Labor Standards Act. So those are questions of labor law. and attorneys are more equipped to answer that. So a lot of people ask us, is this 500 employee threshold based on an entity by entity basis or a consolidated group level? And from what I've been understanding from the conversations I've had with attorneys is that there's a different rule that could apply for the two different types of provisions. So remember, there's the paid sick leave provision and there's the FMLA provision. And there appear to be two different sets of rules. And so one of them could apply on a consolidated basis, but one of them is probably on an entity by entity basis. And there's rules and factors and balancing tests that would apply. So if you're anywhere close to that threshold, whether on a consolidated basis or an entity by entity basis, consult an attorney to make sure that you are either subject to this or you are not subject to this. So again, if you are subject to this act, you have to provide that paid leave to your employees if they want to take that leave. And if you are not, then you don't really have to worry about any of those provisions. So it's kind of the first determination.
With a situation like that, like you said, obviously there's the labor law, there's the tax side piece, right? But then maybe we can approach it even that we're able to help, but alongside an attorney, perhaps. Is that
Yeah, for
fair?
sure.
Okay, yeah.
Because again, yeah, it's a two-sided approach, right? Because the first step is, one, am I subject to this? And that's, I think, more better suited to go ask a labor law attorney, and they can help you figure out, are you subject to this or not? If you figure out you are subject to this, then if you're subject to it, you're mandated to provide this leave. If you're providing this leave, the government is subsidizing it with tax credits. So once you figure out you're subject to this, come to us so we can help you calculate your exposure on the amount of wages that you would be exposed to pay under this act. And we can do different scenarios to figure out, okay, this many employees take this much leave. So we can run through the scenarios with you and basically calculate your exposure. And then we can also help you calculate the corresponding tax credits that you'll receive and then walk you through the mechanisms of applying for the tax credit. So I guess the first, again, it's kind of a two-step process, right? Figure out if you're subject to this, which an attorney can help you figure that out. And then if you are subject to this, come to us and we'll help you figure out, again, your exposure and the tax credits that you'll get to help cover the cost of providing this for your employees.
Let's now hear from Julia with questions on how the provisions of the second relief package fit and work with the provisions of the third relief package.
The way that all this guidance is kind of coming out at the same time, it gets kind of muddled and confusing, trying to pair up, okay, if I'm subject to this, what does that mean? And then how does it interplay with these other provisions that came out with this other relief bill? So one question that we were getting when the Families First Act came out was whether those rules apply to layoffs or companies that had to shut down because their main source of income was being cut off, which is a great question. And at the time, the answer was the Families First Act only provided credits under specific conditions, and those were those 6 conditions that we talked about previously. If the employee is being directly impacted by COVID-19. On the flip side, the CARES Act came in after the Families First Act was passed. And what it did was provide some additional relief to companies that were experiencing those layoffs or shutdowns due to economic stress caused by COVID-19. So one act kind of covers the impact from an employee perspective, and then the other act comes in and provides that extra cushion for companies that maybe their employees are doing well, but the business itself isn't doing well. So the employees aren't able to work for that reason.
Again, I feel like I keep almost repeating this, but it's like a puzzle almost. And I feel like you have to figure out as a business owner, even if it is a tax preparer, right, how to put the pieces together because they are coming in different relief packages. I don't know, any questions on some of the specifics of the backward looking things? I mean, Julia, you and I have spent so much time in the last, we'll call it 2.5 years. I don't know however long it's been since the TCJA was enacted. And then this is obviously making a lot of changes there. Do you think it's too soon to tell kind of what some of the questions might be, or are those starting to kind of crop up as well?
Yeah, I think at this point, a lot of the focus is companies wondering, how am I going to make payroll? How am I going to literally keep my business up and running? How am I going to survive this quarter? And a lot of the kind of backward looking provisions that provide those refund opportunities, that's not going to put cash in those companies' hands today. People are more concerned about those provisions that Yelena talked about, the cash deposits for individuals, the payroll relief that's going to be applicable now for those companies. So now, with that said, we at BKD in the National Office Tax Department, we're definitely looking into those those situations and identifying those opportunities for our clients. But we realize that their focus at this point is literally just trying to make it through this month, this quarter. And then once we help them come through that portion of this difficult time, we'll be there waiting to provide them with that additional relief opportunities through those refund opportunities that we've identified on their behalf.
I don't know, Yelena, how about on those payments? Like you said, that I feel like these rebates are the most publicized aspect of all of this. And obviously, it's going to probably remain to be seen a little bit how it actually gets paid and the timing and all the pieces that are involved logistically with it. Getting questions, are you hearing some frequently asked questions related to those?
Yeah, I mean, I think it's all the questions you would expect is like how soon are we getting the check in? That is unknown. The access as rapidly as possible, which is vague. And according to statements from the Treasury, they expect to get those out from with between like 1 to 3 weeks, I think, the last I heard. And if the IRS has your electronic information, it's going to be on the faster end. And if you're getting a paper check, it might take a little bit longer.
Back on the subject of deadline relief, another common question we've been getting is what it means for estimated payments. And specifically, can you, so to speak, roll any required second quarter 2020 estimated payment that's due June 15th into an extension payment made July 15th? I'll take it back to Julia for this one.
You know what, Damien? I know that you're a leader in the firm in the PCS space. So I'm curious your thoughts on that question and what you're telling your clients. Is that something that maybe you could help shed some light on for me?
I love it. You're turning the microphone back around. What I would say is it's clearly not addressed in the guidance, other than we know from a federal perspective that with the FAQ that we got, that it does not cover Q2 payments that are due June 15th. And so I think it's such an unprecedented thing that we're even looking at and what we're dealing with right now, that there isn't a lot of certainty. We don't know for certain. We don't have official guidance on it. So I think it's a risk for sure to take that approach and do that. I mean, obviously the spirit behind all of this is working with people and when there's a real need and perhaps there's reasonable cause for penalty abatement and things like that you can look at. But I think in terms of the actual kind of guarantees, you got to, we don't know. Nothing's guaranteed because it's not addressed. To that end, though, I would also maybe suggest that, and perhaps this is maybe even some of the thinking, that unfortunately with the current situation, as you alluded, many businesses are struggling to even just figure out how to make payroll, how to keep the operations going, or maybe they can't because of stay at home or shelter in place type orders. So as a result of that, they might not actually need to make a second quarter estimated payment because unfortunately that if there's no income, there's no tax if on an annualized basis. So it may become somewhat of a moot point as well, I would say, but absolutely something to watch for, and perhaps maybe we'll even get additional guidance on by the time June 15th rolls around. But I know it's definitely been a hot topic, especially when you even think about the states, because not all the states are covered obviously under the federal guidance, and every state's doing it a little bit differently. There's actually a great resource out on the AICPA's website, and that's kind of tracking all of that as that's coming down. But because of that, some states you still have to even look at Q1 payments that maybe even are still due April 15th, like my state here of Illinois. That's the case, at least as of right now. So that being the case, I think you just got to be really careful. And I don't know that I would personally feel comfortable making that recommendation at this point in time, just given the fact that there's risk in it because we don't know. What do you think? How did I answer? How did I do?
That was very helpful. Thank you.
Let's kick it back to Yelena on a frequent question I'm hearing on what documentation you need for paid sick and family leave.
The IRS just released an FAQ page, and as part of that information that's been released, they've provided some guidelines for what kind of documentation that employers should be asking employees who want to take this type of paid sick or expanded family leave. And basically, it's what you would think. It should include the employee's name, the dates when the leave is requested. So the basic information you would probably ask anytime an employee takes time off. But they also would like a statement from the employee explaining what type of leave they're asking for and the reason they're asking for the leave. And then also a statement that says the employee is unable to work, including by means of telework, for the reason that they're asking to take the leave. And so in the case of a request based on a quarantine order or a self-quarantine order, or advice, I guess, if you choose to self-quarantine because maybe you've been advised by a healthcare advisor or you've been in contact with someone who's sick. The statement from the employee should include the name of the government entity ordering quarantine or the name of the healthcare professional advising self-quarantine. And if the person subject to quarantine or advised to self quarantine is not the employee, the person's name in relation to the employee. So, for example, if your child is asked to self quarantine, you'll just have to provide the relation that it's your child that's requiring you to take this leave. For the childcare exception, so again, remember that one of the reasons you can take paid sick leave is if you don't have childcare or your child's school is closed. That qualifies you for 2 weeks of paid leave and up to 10 weeks of expanded FMLA leave. For that, you need to have a statement that provides the child's name and age. And if there's multiple children, you list those out. And then the name of the school that's been closed or the daycare that's no longer available. And then you need some kind of notice or email or some kind of proof saying that the school or daycare was closed. So, I mean, it's kind of what you would expect, but just something to substantiate why you're taking the leave, because again, this leave is limited to certain types of reasons, and you have to be able to, I guess, support that to make sure you're using it for the right reasons.
Let's now take some questions from Simply Tax listener and BKD tax intern Elizabeth Baker.
Does the deadline relief provided apply to payroll or excess taxes?
The notice that was issued extending or postponing the April 15th deadline says that normal filing, payment, and deposit due dates continue to apply both payroll and excise taxes. However, under the CARES Act, there is a provision allowing employers to defer the Social Security portion of their payroll taxes. So, again, just to repeat that so it's clear, it's the employer's portion of Social Security tax that may be deferred. And the deferral works in that you defer half of it that will be due December 31st, 2021, and the remaining half that you defer is due December 31st, 2022. So if you find that you are kind of short on cash or you need to cover some of these unexpected costs when your revenue is down or whatever, for whatever reason, there is that option with your portion of Social Security tax to defer some of that or all of it kind of into the future to give you more of a better cash flow. So it's not a postponement per se, but more of a deferral. But you should still file your regular payroll filings like normal. And we're expecting more guidance from the IRS on how exactly you let them know that you're deferring. But as of now, it's just kind of an option to help with cash flow.
Speaking of that deferral, another great, important, and very common question I've been getting lately relates to the interplay between the ability to defer the employer's portion of the payroll tax and the loan forgiveness available under the Paycheck Protection Program, or PPP, that you know me, I asked guest Jim Ashley to explain in episode 93. Yelena, what do we know about it right now?
So we haven't really gotten guidance on that as of now. It just says that if you're participating in the Paycheck Protection Program with the SBA, you're not eligible to defer your payroll taxes. Because all this just recently released, we're trying to figure out how all of these different provisions interplay with each other. So I think the advice that at least I've been given to people I've been talking to is becomes a cost benefit analysis and determining your business needs, how immediate the need is for cash. And again, the thing with payroll is you already have this money, you're just keeping it for longer. Versus the SBA loan, there's a process to apply for it and you get it. So again, this is just kind of a cost benefit analysis, not only running the numbers, but considering how immediate your need is, how big the need is your deferring payroll sufficient for you to cover that need? And if it's not, then maybe you consider the SBA loan program or vice versa. So I guess it's just kind of going through all the options and making sure you're choosing the best one for you and your business.
Let's take a few more questions from listener Elizabeth Baker.
I'm a college student and I file my own income tax return, but my parents claim me on their income tax return. Will I be able to get a rebate check?
The rule is every adult taxpayer gets $1,200, and if you're married filing jointly, you get $2,400. Plus, you get $500 for each eligible child, and eligible child's defined as under the age of 17. So if you're 17 or over and claimed as a dependent on someone else's return, which is primarily college students, even if you filed your own return, if someone else claimed you as a dependent on their return in 2019, you do not get a rebate check.
Is the money I receive from my relief check considered income? If so, will it be taxable income on my 2020 return?
The way this recovery rebate check works is it's an advance credit on your 2020 taxes. Just like any credit that you get, like the earned income credit, it will decrease your taxable income in 2020, and you'll have to recalculate it on your 2020 income. And so the questions are, well, what if I have another child in 2020? Technically, I would have gotten that $500. Or what if I phase out in 2020? Do I have to pay it back because I should have gotten less? And the bill as it's currently written and as it passed Congress doesn't allow for a mechanism to address those issues. So we don't, as of now, you don't have to, it appears that you don't have to pay back if you got more than you should have, but you'll just have to recompute it and recalculate that as a lesser credit on your 2020 returns and vice versa. And so we're expecting more guidance from the IRS and Treasury and how that mechanism is going to work come time to file your 2020 returns. But this is an advance credit basically on your 2020 taxes.
Let's go back to the Families First Coronavirus Response Act and take one last question from Yelena that's been coming up a lot lately.
A lot of people are confused about the small business exception to the paid leave provisions under the Families First Act. So that's the act that provides up to 12 weeks of paid leave for employees who are unable to work or telework due to a variety of reasons, but mostly being sick, taking care of someone who's sick, or not having childcare. And a lot of people are kind of confused about the exception. We're still waiting for official regulations to come out on this, but as of now, the guidance they've gotten from the Department of Labor and the IRS is that that is a hardship exemption that you apply for. So you're not automatically exempt, it appears. You have to document and be able to show the Department of Labor of why providing this paid leave is a hardship for you. And there's a Department of Labor FAQ page you can access, and they list the different situations that constitute a hardship exemption. And they also tell you what kind of documentation you should be keeping to support for why you can't provide this paid sick leave. And on the flip side, we get asked, well, what if I can apply this and I want to apply this, but I have under 50 employees? Can I still provide this and get the tax credits? And yeah, you can. If you have under 500 employees, you can still provide it, even if you're a small business, if it's not a hardship for you to provide that. And again, there is a mechanism for paying for this type of leave where you can get advances on the credits. So the IRS is expecting to process those requests in under 2 weeks.
All right, let's wrap up with one last popular question from Elizabeth.
Several of the provisions of the CARES Act are retroactive, including a 5-year carryback for NOLs. What is the process for doing that if the tax year is already closed under the statute of limitations?
Well, I guess we've exceeded the number of minutes in a free Zoom call, so I'd better take this one. So prior to the enactment of the CARES Act, and going way back to what feels like an eternity ago, back in the days before the TCJA, a net operating loss, or NOL, was generally required to be carried back to the 2 preceding tax years, with any excess NOL then carried over to the 20 succeeding tax years. Under the TCJA, NOLs generated in tax years beginning after December 31, 2017 could no longer be carried back, but carried forward indefinitely. But now, under the CARES Act, there's a special provision that allows NOLs to be carried back 5 years for losses arising in the 2018, 2019, or 2020 tax years, as Julia told us earlier in the episode. Mechanically, Section 2303 B1D52 of the CARES Act provides that the election for a 5-year carryback for the 2018 and 2019 tax years shall be made by the due date, including extensions for filing a taxpayer's return for the first taxable year ending after the date of the enactment, or March 27, 2020, which is similar to the relief provided in 2019 when we last saw a similar 5-year carryback provision. At that time, we received a revenue procedure prescribing the 2 methods for making the 5-year carryback election, which were either to attach a statement to the tax return or amend a tax return for the NOL year, or to use either Form 1139 for corps or 1045 for individuals, or Form 1120X or 1040X, and file by the due date, including extensions of the taxpayer's last tax year beginning in 2009. And great question, by the way, on the statute of limitations. Section 6511A and 6511D2A provide a longer period of time for filing an amended tax return for an earlier year to carry back an NOL from a later year. So basically, all this is a very, very long way of saying that we expect that there will be 2 options for doing this, and we're awaiting guidance on the procedure to follow, which we'll hopefully receive guidance soon on to help taxpayers benefit from the loss-related relief provided. I think we'll go ahead and call it a day and stop there for now, though there are certainly no shortage of questions that are flying, and as you probably noticed, we didn't even dig into the questions and confusion swirling on the Paycheck Protection Program loans right now. to avoid adding to the confusion, I think we'll let the dust settle on that one and tackle those questions in a future episode, and go ahead and refer you back to episode 93, for what I thought was a great discussion with guests Jim Ashley, Corey Stone, and Greg Knight on what we know, and perhaps importantly what we don't know about this new program. Check out the show notes available at bkd.com/simplytax for more about Ed, Yelena, and Julia, as well as the links to the resources that we mentioned in the episode today. You can also get resources on important tax and accounting changes and learn more about the latest tax and accounting developments related to the response to the new coronavirus at bkd.com/COVID-19-resource-center. And if you're like me and have lots of questions right now, let me know on social media. You can find me out on Twitter, where I tweet about tax at Damien Martin CPA, on Instagram, where I post about my life at the intersection of tax and being a dad at TaxDad, on YouTube by subscribing to our Simply Tax YouTube channel, and out on LinkedIn.
I'm Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.